Are we going to see the housing market crash in 2023? And what are interest rates going to do over the next 12 months? Those are things we're going to discuss on today's episode and a lot more. If you've never seen this show before, hi, I'm Josh Alexander and your host of Orange County Housing Market News, your one-stop shop for all things Orange County real estate. So on today's episode, we're going to be going over my 2023 housing market forecast for Orange County. So if you're thinking of buying or selling a home next year, you're not going to want to miss this episode. So let's go ahead and get into it. What a wild ride it's been in 2022 for the housing market. So we started this year with the hottest housing market we've ever seen. Homes were flying off the shelf, $50,000, $75,000, $100,000 over asking price. However, as we approached summer, all of a sudden interest rates spiked. We saw them more than double, which dramatically slowed down the housing market. In fact, it was the fastest increase in interest rates that we've ever seen as well. So needless to say, there's been a lot going on in the 2022 housing market, but that housing market is pretty much done now. So we're going to go ahead now and look forward to what to expect in 2023 based on what's happened this year. So there's going to be a lot of topics to discuss on this episode, so I'm going to try to stick to the main points and make it as brief as I can so this video doesn't end up being an hour long. So let's go ahead and review what we're going to actually go over. So first, we're just going to talk about briefly where we are now in the housing market in December 2022, because that's going to set us up on what to expect as the new year begins. Then we're going to talk about what you should expect interest rates, supply, and demand to be doing in the Orange County housing market through 2023. Then we're going to talk about the biggest question on a lot of people's mind: is the housing market about to crash? And we're going to go over a lot of data around that so you can have a better understanding of what's actually happening in the market. And then finally, we're going to talk about some risks to the housing market as well as some trends developing that you probably want to know about. And then we're going to end everything with my recommendations for both buyers and sellers if you are thinking of getting into the housing market over the next 12 months. Now, if there's a question that you have that I didn't answer about next year's market, feel free to put it in the comment section below, or if you disagree or agree with any of my points, let me know as well, because I love to get other people's opinions. So let's go ahead and first start with where the housing market is right now so we know where we're going as we get towards the beginning of 2023. So on the supply side of things, right now in Orange County, we have a little bit less than 3,000 homes on the market. Now this probably doesn't mean a lot to you since you're not looking at these numbers daily like I am. So just to give you some context, during a typical year, we usually have about 4,000 homes on the market at this time. So right now there's about 36% fewer homes on the market than during a typical year. Now on the demand side of things, it's very similar. So demand, also known as pending sales, how many homes are in escrow, is down by 36% as well. So supply is down by 36%, demand is down by 36%. The only thing you really need to understand though is during this time of year, we're typically going to have more supply than demand. So even though those numbers are the same, we still have a little bit more supply than demand right now, which means home values are currently falling slightly every single month and have been since the end of summer, early fall. Now, the biggest story over the last month, as well as actually the entire year in the housing market, has been interest rates. So since the beginning of November, we saw rates go from 7.2% all the way down to 6.13% where they are today. And today is December 16th, just for reference. So they've dropped by more than 1% in just a little over a month, which has made a huge impact on the amount of affordability that buyers have in the market. In fact, a typical buyer right now can afford 12% more home than they could just a month ago. So the rates going down have been extremely helpful for any buyers that are thinking about getting in the market, because affordability is going up right now instead of down like it has been over the last 2 years. So why have interest rates dropped so significantly over the last month and a half? Well, it has everything to do with inflation. So the last two CPI reports that came out going over October and November's numbers have both come back lower than expected when it comes to inflation. So the market at this point is starting to realize and understand that we've probably hit the peak inflation number and we're starting to come down. And when inflation comes down, so do interest rates. So that's been the main driver of interest rates coming down over the last month and a half. In fact, when that first positive CPI report came out in November, we saw interest rates drop by almost 0.75% overnight, which is the fastest drop that we've seen in recent history for interest rates. So interest rates are still going down every single week as we approach the end of the year. And another effect of interest rates going down is the average days on market, so the time the seller puts their house on the market to the time it goes in escrow, has actually started to drop again. So in November, it was hovering around 87 days, which typically is actually pretty average for this time of year. However, today it's dropped down to 77. So surprisingly, the housing market is actually heating up a little bit as we get towards the end of the year. And again, that has everything to do with the interest rates dropping. We're seeing mortgage applications go up week after week. We're seeing more people applying for these loans because they see these interest rates dropping and they just want to be prepared to start purchasing a home as soon as next year comes. Okay, so now we know where we are, but why most of you are here is because you want to know what to expect in 2023. So let's go ahead and start going over that now. And let me first start off by saying that I do not have a crystal ball. I'm never going to be able to predict 100% accuracy exactly what's going to happen. And if history, especially over the last 2 years, is any indication, there's always going to be some type of curveballs that are thrown your way during the year that is going to mess this data up. However, what I can do is I can give you all the current trends in the data, what's happening right now, as well as look at all the historical data to give you a much better idea of what you should expect to happen in the housing market if everything continues with the current trends. So let's go ahead first and start with interest rates, because I know it's on a lot of people's minds right now. So there is some very compelling arguments to be made that during 2023, you can continue to expect interest rates to slowly creep down. And there's 3 main reasons for this, so let's go ahead and go over each of them. So the first one, and probably the best indicator of where interest rates should be, is the spread between the 10-year Treasury note and the 30-year fixed mortgage. So let me go ahead and explain. Over the last 35 years, on average, the spread between the 10-year Treasury and the 30-year fixed mortgage has been about 1.7. So when the 10-year Treasury goes up, so do interest rates. When the 10-year Treasury goes down, interest rates follow as well. And you can check out this chart up here if you're watching this on video, and you can see how directly correlated they are. They almost look identical in terms of their ups and downs. The only 2 exceptions to this is right when the lockdown started during COVID, and then right now. In fact, right now is the largest spread that we've ever seen between the 10-year Treasury and that 30-year fixed mortgage over the last 35 years. And that spread is 2.7, so a full point higher. So right now, the 10-year Treasury is at 3.46. So if we had that normal spread of 1.7 that we typically do over the last 35 years, we should be looking at interest rates right now right around the 5.16%, so in the very low 5s. However, because that spread is much higher right now, that's why we have rates in the 6% range. Now, why is that spread higher? Well, it comes down to 2 main reasons. So number one is uncertainty in the market. When there's uncertainty in the market, that spread is going to be higher because people don't know what to expect. So that is going to artificially inflate that number, and until you have certainty, you can't expect that to go back down. However, in 2023, as we see inflation start to ease and as we see more predictability come back into the market, you can expect to see that spread start to shrink, which should drive interest rates down. And the second main reason why that spread is a little bit higher right now has everything to do with loan servicers. So I'm not going to go into a giant amount of detail with this. Just know that loan servicers are charging a little bit more right now because they're also expecting interest rates to go down. And when interest rates go down, they're going to start losing money. So that's why that spread is a little bit higher right now as well, because they're trying to make up for that difference. So between those two, that's the majority of why you see that extra point in the market right now. So as those start to go down, as inflation starts to go down, you can expect that gap to go back down to more of a normal range. And just that alone is going to get rates back into the low 5s if we can get back to a normal range. Now, the second reason I'm expecting interest rates to go back down next year has everything to do with inflation. So as inflation goes up, interest rates follow. As inflation goes down, interest rates go down as well. So as we've seen over the last 2 months, inflation has finally started to cool off. It looks like we've peaked, and as long as that trend continues, you should see interest rates go down as inflation goes down as well. So the faster inflation drops, the faster you can expect to see interest rates go down next year. And then the third and final reason I expect interest rates to go down next year has to do with recession. So the housing market has already been in a recession since the end of summer. However, officially at least, the US is currently not in a recession. However, they are expected to be in a recession sometime in the first 2 quarters of next year. So if a recession happens, which again is pretty likely at this point, if you look over the last 50 years during every single recession we've had, that's 100% of recessions, interest rates have dropped by the end of that recession. So when you look at all three of those factors combined, there's a very good chance that you're going to see interest rates start to go down next year and be much lower than they are right now. So how much can you expect interest rates to drop next year? Well, if you're waiting for rates to get back into the 2 and 3% range again, you're going to be waiting for a very long time because it's likely that we will never see interest rates that low again. Yes, it could happen, but that set of circumstances that made that happen, again, are not very likely to happen, and getting rates back that low is something that you can dream about, but the probability is just not really there. However, based on the data and everything we just talked about, it's completely reasonable to expect interest rates to go someplace between the low 5s and mid 5s sometime next year. When is that going to happen? Again, it's going to have everything to do with how fast inflation comes down, as well as the rest of the economy does. However, at some point next year, there's a very good chance that we should see rates in the very low 5s. Could we see rates even lower than that, maybe in the high 4s? Well, it's possible, but at this point, I think the most likely situation is going to be rates somewhere between 5.1 and 5.5 for a good chunk of next year. So now let's go ahead and look at the supply side and the demand side and what to expect in 2023. So on the supply side, you can expect the supply in 2023 to remain relatively low, and there is a lot of reasons for that. So let's go over some of the main ones. Number one is something called a mortgage rate lockdown. So what that basically is that anybody that owned a home that refinanced during the time where we did have those super low interest rates, or if they purchased during that time and locked in those super low interest rates, are really going to have a hard time wanting to upgrade to a different home when they're now going to have to pay double mortgage just to maybe get an extra bedroom or bathroom. Because rates have gone up, because housing prices have gone up, there are going to be a giant premium for anybody that wants to upgrade to a new home right now. So unless these homeowners are forced to move for a job relocation or health reasons, a lot of them are just going to stay put, wait it out, and hope that rates continue to drop until it gets to a point where it makes more sense for them to upgrade to a new home. The second reason you can expect supply to remain relatively low next year has everything to do with the new homes being built. So right now, housing permits have plummeted off a cliff ever since interest rates got up. Builders do not want to build homes right now when they know the demand's not there and they're not going to make as much of a profit. Just in October alone, housing permits dropped by 30%. So yes, there are some homes that are being built right now that will come on the market at the beginning of next year, but about halfway through next year, you're going to see a lot of those homes just stop coming on the market. They're not building right now, and there's just not going to be that many new homes available, especially in the back half of the year. On top of that, a lot of these builders right now are building for rental properties, not for single family owners. So a lot of them are basically being built to rent. They're going to be condos, they're going to be multifamily units, because investors want to purchase those to be able to get more profits and have that steady stream of income, especially because rents have gone up so significantly over the last couple years. So a lot of those homes coming on the market next year might help renters out a little bit by increasing the supply of rental properties, but isn't going to do much for those trying to purchase a property. And then the third reason in terms of supply is that people are just not moving as often as they used to. So back in the 80s and 90s, it was common for most people to move every 7 to 9 years. Fast forward to right now, when you look at the studies, depending on which study you're looking at, most people are staying in their home anywhere from 12 to 18 years. People are just not moving, they're staying put. If they have equity in their home, they're maybe adding an addition to the house, they're doing anything they need to inside the house itself to make it more comfortable for them versus moving to a new property. And this trend is continuing to grow. Every year, more and more people are staying put for longer and longer, which is freezing a lot of the housing stock right now. So for those three reasons, as well as other ones we won't get into today, supply is going to remain relatively low throughout next year. Now you might be thinking to yourself, wait a second, Josh, you didn't talk about all the foreclosures that are going to happen just like they happened back in the last housing crash that's going to drive down prices, and I'm going to be able to get a bargain on the next home that I purchase because the banks are going to sell them at a discount. I've said this probably 100 times on this channel by now, but there is going to be no foreclosure wave coming anytime in the near future. There is no data to indicate that. Ever since the last housing crash, banks have been very strict about who they're lending money to. Right now, the lender profiles of homeowners have never been better in the history of the United States. They're qualified, they have good jobs, they can afford the home that they're living in. Another thing you have to look at is the people that might have lost their job. They have a lot of equity built up in their home. Right now in the United States, there has never been more equity in homes than any time in US history. So if they have to sell their house because they lose their job, they're selling it at market value. They're not going to be selling it at a 20-30% discount. They're selling it at market value. They're going to take a chunk of change, maybe rent a property for a while, move, do something, but it's not going to impact the housing market. Now, just to drive this point home one more time, currently in Orange County, there is 9 foreclosures or short sales in the entire county happening right now. Do you want to know how many foreclosures we had at the height of the last housing crash? 6,000. Nearly 1 in every 3 houses on the market in 2008 was a foreclosure, and that's why home prices crashed, was because all the banks were selling at a discount because there was just way too much supply. So there's 9 foreclosures right now. There were 6,000 foreclosures when we had the last housing crash. You can see that we're not even close. The data just doesn't show there's going to be any wave of foreclosures hitting the market at any point in the foreseeable future. Okay, so now that we put that to bed, hopefully for the last time, let's go ahead and now transition to the demand side of things. So for next year, I do expect demand to also be relatively muted compared to a typical year. However, there will be a baseline demand that's always going to be there next year, and that has everything to do with the largest demographic patch in the United States right now, the millennials, reaching peak home buying years, so early to mid 30s. They're going to keep that demand baseline relatively high. In fact, last year, 42% of all homes sold were sold to millennials. So millennials make up a giant chunk of the home buying market right now. And yes, affordability is down. Yes, interest rates are high, but there are so many millennials out there right now that you're going to have that baseline demand. Now, on top of that, the biggest indicator of where demand is going to go has everything to do with interest rates. As interest rates drop, demand grows. And like I said before, I am expecting interest rates to continue to drop as we go through next year. So I am expecting demand to start to rise month after month as those interest rates drop. And like I said before, we're already seeing this happen with the mortgage applications. We're seeing the mortgage applications go up because the interest rates have gone down. And I expect that trend of higher demand continuing as those mortgage rates go down. Now, just to give you some quick data on what demand level is needed to help balance the housing market, last year at the end of summer, when we saw interest rates right around the 5.3%, we saw a balanced market where neither the buyer or the seller had any significant advantage when purchasing a home. So if we get rates back into that range again, there's a very good chance that we're going to be back in a balanced market. And actually, because home prices have dropped since last summer, that demand is probably going to be even higher if we hit rates around that same 5.3% range. So again, for the demand side of things, you have that baseline to go off of, and a lot of the other demand is going to be based on where interest rates are headed next year. Okay, so demand is going to be lower next year, supply is going to be lower next year, interest rates are going to go down next year. So what does this actually mean for home values? Well, if you look at all the major economists out there for the housing market, there's a pretty wide range of what they expect to happen in terms of home appreciation. So on the negative side of things, we're seeing some economists predict all the way down to 8.8% depreciation next year. And on the positive side of things, we're seeing economists predict up to 5.4% appreciation. So you can see it's all over the board. No one really knows exactly what's going to happen with appreciation or depreciation in the housing market next year. However, if you're watching this on YouTube, I'm going to pop this up here. This is all the major predictions so you can kind of see the spread. I tend to focus more on the ones that are looking at California and Orange County specifically. And when you look at those are the ones predicting the highest amount of depreciation happening in Orange County next year. So for my predictions, I'm putting more weight on the local information, but also taking into account all these other economists as well. And I'm predicting by the end of the year next year, we will see some depreciation in the market, probably somewhere between 4 and 7%. Now, a lot of that most likely is going to happen in the first 6 months, and I'm predicting in the second 6 months we're going to see a relatively flat housing market, because that's when most economists predict that rates are going to be back into those low fives again. And again, at that point, we're going to have a more stable housing market where you're not really seeing any movement in appreciation or depreciation. Now again, I don't have a crystal ball, but I try to take as much data as possible, put it all into something easy to look at, and again, give you a prediction based on what's most likely to happen so you can make more informed decisions. Now, is there a path to see appreciation in Orange County next year? Absolutely. If interest rates drop quicker than expected and more than expected at the beginning of the year, you could see the market get into balance very quickly, and then by summer, you might start seeing appreciation happen in the market again. But again, I'm trying to give you what I think is most likely to happen based on the current trends, and based on that information, I do think we're going to see a little bit of depreciation in the Orange County housing market by the end of next year. So the last thing I want to say about the home values really quick is you can see that no major economists are predicting a large-scale crash in the housing market. Yes, housing prices might drop by a few percent, but that's completely normal in a normal housing market. Some years it goes up by a few percent, some years it goes down by a few percent. So we're trying to get the housing market back to normal. It's going to take a while for people to adjust to that because these last couple years have been insanity, but that's a normal housing market where some years you have prices appreciating, some years you have prices depreciating, but that's just a normal housing market and people have to get used to normal again. Okay, so we're getting close to the end now. So let's go ahead and talk about risks to the housing market. So risks, there's always going to be risks in the housing market. You're never going to be able to predict with 100% certainty exactly what's going to happen economically in the US as well as around the world that could impact the housing market. But let's look at some of the at least more probable things that could happen that could impact the housing market negatively. So number one is inflation starts going back up. So let's go ahead and say the next CPI report that comes out, we start seeing inflation go back up again. That's going to shoot interest rates back up, and that's going to lead to faster depreciation in the housing market. And if inflation continues to go back up, we can see rates go back up into the 7% again relatively quickly. So is that likely to happen? At this point, I don't think so. But let's go ahead and wait for the next CPI report to come out, which is the second week of January. And if that shows that inflation is the same or even lower, then that's a good indication going into 2023 that we're not going to have a lot of issues. The more months we can stack up of positive inflation news, the less risky that's going to be for the housing market. So by February or March next year, we should know pretty certainly if we're going to have any issues with inflation or not. Now, the second thing we have to worry about is the Fed's overshooting their interest rate hikes and hiking it too much, which creates a deeper recession. People start losing jobs in mass numbers, and people have to start selling their homes because they can't afford their mortgage anymore. Now, again, is this likely? Probably not, but it's something that I'm continuing to watch. Now, the Fed is already forecasting a recession next year, so they predict that it's going to happen. They're starting to slow their rate hikes down, so it looks like all indications are yes, they're going to continue to raise rates next year, but at a much slower pace. And as they like to put it, they're trying to engineer a soft landing. Is that going to happen or not? It's going to be very hard to tell. We're really not going to be able to know until probably mid next year. But again, around the summertime next year, we should have a much better understanding of where things are heading. And again, like I talked about at the beginning with interest rates, the less uncertainty we have in the market and the more we drive that down, which should happen in the first 3 to 6 months next year, the lower you're going to see interest rates get. So as long as everything lines up how it's currently trending right now, we should have interest rates going down pretty significantly by the summer of next year. But again, we'll have to watch every single month as the data comes out and see what the Fed say as they continue raising their rates. So buyers, the good news for you is that affordability over the next couple months should continue to get better for you. Interest rates are trending down. Depreciation is happening slowly in the market right now, which means homes are going to become more and more affordable for you. Over the last month and a half alone, you can now afford a home that's 12% more expensive while keeping the mortgage the same as it would have been a month and a half ago. So don't expect that trend to continue. I think we saw that giant rate dip when the CPI started showing that inflation was turning, but don't expect every good report in the future coming out about inflation to have that big of an impact on interest rates. So just for an example, the one that was just released in December, we didn't really see rates jump that much. They dropped by maybe 0.15%. So you can see it's kind of a law of diminishing return. There's a lot of excitement when we started seeing that change and inflation go back down. But at this point, when those numbers come out, you can expect if they're positive, you can see maybe a 1/10 of a point decrease, maybe a 1/4 point if it's really positive news, but you're not going to see a quick drop of interest rates like we did when that first positive CPI report came out. So just kind of keep that in mind. It's going to trend downwards, but at a much slower rate than it has been over the last month and a half. So as someone that's thinking of buying a home, this is always my advice for you. If you're thinking of buying a home for the long term, you're not an investor, you're not trying to speculate on the market, you're buying a house for you and your family to live in, you need to be looking at your monthly payments. That is the most important number. The market is always going to go up and down. It's going to change from year to year. However, in the long term, you're going to be able to have a home that's going to appreciate and be worth more than it was when you purchased it. And I know this saying is cheesy, but it is true when it comes to buying a home for the long term. Time in the market is always going to be better than time in the market, which basically just means purchase a home when you can afford those monthly mortgage payments and hold on to it. You have a great house. You don't have to worry about your payments going up. You don't have to worry about your landlord increasing your rent every single year. You have that predictable payment. If you can get into a house in the neighborhood you want to be in, maybe it's not perfect, maybe it needs some updates, but over the years you can slowly update it and you can have a property to call your own. And in 5, 10, 15 years, you're going to have some appreciation happen on that property. That's always been the case in the housing market. Housing prices have always gone up in the long term. So my second piece of advice for buyers right now is that in today's market, lenders are being very competitive with each other. Their business is down, their refinance business has dried up because no one really wants to refinance when rates are in the 6s. So they're being competitive with interest rates, which means for you, you want to make sure that you shop around when you talk to a lender. Make sure you're talking to at least 2 to 3 lenders before you figure out who you want to go with. And that way you know you're getting the best interest rate with the best program that's going to be right for you. And the second thing that I encourage you looking at with lenders is their communication. Are they able to explain everything in a way that you understand? Is everything going over your head? They're just talking too fast. You want to make sure that you're working with someone that's going to take the time to explain everything for you, because it's going to be one, if not the largest purchases you've ever made, and you need to understand everything going on in the lending side of things because that has everything to do with your financial health. So make sure you're not only getting the best rate, but finding someone that you know that you can trust and that's going to explain the process to you. So you're not going to have any unexpected surprises financially after you purchase the home. So my third advice for buyers is that you need to understand the timelines involved when purchasing a house. So I have a lot of first-time home buyers that might be renting a property, and let's say their lease doesn't expire for another 6 months. They're not even thinking about purchasing a home at this point yet because it's too far away. Well, you have to understand that it's going to take you probably 4 to 8 weeks on average to go through the pre-approval, look for homes, find a house, place an offer, and then finally get into escrow. And then once you're into escrow, it's going to take another 30 days to close escrow. And then financially, it's also important to understand that typically you're not going to be responsible for that first mortgage payment for usually 45 to 60 days after you close escrow. So if you're worried about having to pay double payments, one on your rental and one on your new mortgage, you have to understand when you're going to actually be responsible for that first mortgage payment. So for instance, let's say you close on your home on May 25th. Your first payment is not due on June, it's going to be due July. So you just want to make sure financially you can understand that, so when you go about planning on when you want to purchase your home, you can work backwards. And I recommend having at least 5 months of time before you actually need to be out of your rental when you start looking for your property. Now, if you haven't purchased a home before, or it's been a while since you purchased your last home, and you want someone to walk you through the entire home buying process from where you are now to going through the pre-approval, to looking for homes, placing offers, going through escrow, all the way to where you get the keys handed to you, feel free to reach out to me anytime. I'll do a home buyer consultation with you, answer all your questions, and walk you through the entire process, so when you are ready to buy a home, you'll know exactly what to expect. Or if you're not quite ready to talk to someone yet, I'll also throw a link in the comment or description below that goes over the 25 steps of purchasing a house, as well as how to budget for a home, so that way you can at least look that over and start preparing yourself for what you need to do when the time comes to purchase a house. Now, on the selling side of things, there's a couple recommendations I'm going to have for you going into 2023. So like I talked about, homes are currently going down in value. So the faster you can get your house in the market in 2023, the higher price you're going to be able to get for it. So instead of waiting for the spring market to sell your home, I highly recommend that you get your house on the market sooner than that this year. That way you have less competition, as well as your home value is going to be a little bit higher. And then second is who you hire is definitely going to matter in today's housing market. So last year you could take some cell phone photos, throw it on the MLS, one weekend later, you'd have 10 offers, 50 grand over asking price, and you'd be in the escrow. Today's market is completely 180. If you don't have it marketed properly and making sure that as many qualified buyers see your house as possible, it's going to be very difficult for you to sell your home in today's market. The average time on market, like I said, is over 2 months at this point throughout Orange County. So if you don't want it to take that long to sell your house, you need to make sure you're hiring someone that's using all the different marketing channels available to them. So what do I mean by this? So not only do you need to take professional photos, but you should also be doing 3D walkthroughs, videos of the home. You should be having floor plans made of the home, and basically anything you can do to be able to get buyers looking at your house before they get there. Because in today's market, most people are going to see your house for the first time on the internet. They're not going to open houses first. They want to check it out. They want to click a few buttons, walk through the house virtually, and figure out if it's the right home for them. And if you don't have that information available for them, they're just going to move on to the next house. So when you're interviewing agents, make sure you're really deep diving into their marketing plan and how they're going to expose you on Instagram, on YouTube, on Facebook, targeting people that actually want to purchase your home and that are qualified to purchase your home. So that way you have the best shot of selling your house for the highest price and quickly, so it's not sitting on the market for months. Now, if you want an example of what to look for when you talk to an agent, you can also look at the description or comments below, and I'll put a link in there into the 10-step process that I use to market homes, so that way it sees as many eyeballs as possible, so you can kind of use that as a guide and understand what it takes to sell a home in today's market. So I hope you found today's information useful. I know it was a long show full of data, full of a bunch of different information, but hopefully you're walking away knowing what to expect in 2023, and you can properly plan whether you're trying to buy or sell a home. So until next time, stay healthy, stay happy, and I will see you on next week's show. Bye.